said his former employer, Goldman Sachs, just came out and it freaking popped up on my news feed in my phone. I swear it's like listening to all these conversations, that they have said the S&P 500 from here on out is going to grow at 3%.
Chunking. So what we would want to do, this time of year is perfect for this, all of you. Because where we want to be is at a Roth IRA. We want to be in the Roth IRA party. Like Jim Belushi and Animal House, we want to be in the Roth party. Everybody's wearing a toga. That's where we want to be.
Welcome, everyone, to the Main Street Business Podcast. We are live here in Scottsdale, Arizona at the end of the Alternative Asset Summit. And we have an amazing live studio audience. Let's make sure everybody hears you. All right.
Man, that was a great recording.
That was a great recording. Yeah, we dubbed that in.
No, this is legit. We're in Scottsdale, Arizona, and thank you to all of you spending a couple days with us. And the culmination of the event, we thought we ought to have
Why not have a podcast at the end of it? You know, like these people heard from us enough. You know, they've been sitting through this all. But we love doing the podcast. This is the hour I look to most forward in the week for myself, is getting to do this with Mark J. Kohler.
Well, Matt Sorensen.
Yeah. Well, you get to do it with me. Right?
Yeah, that's true.
That was what you were supposed to say.
Oh, yeah. And I get to do it with Matt Sorensen. Oh, my gosh. This is fun. This is what we normally do in our podcast. It's just...
This is it, guys.
This is
if you thought there was anything more special of what we were doing, this is pretty much it. This is it. All right, now, here's what we're doing today. Okay, we've got a lot of awesome people here, and I'm saying this in the past tense because there's people listening to it after the fact, all right? And they're going to be asking some questions. But before we did that, I wanted to give a takeaway. Mark can maybe give a takeaway.
Yep.
And then I got two people that I talked to at the break that I thought just had a great little story that I think would be helpful for all of us and all of our listeners of the podcast. Okay. Here was my takeaway. Okay. I just finished talking about Moneyball. Mark and I have joked about that for years. Moneyball is not about baseball. It's about investing and the concept of getting on base. And I freaking love that concept. It's helped me be a better investor and just getting into the right mindset of like, would you quit freaking trying to swing for the fences and just get on base? And that's how you make money over the long haul.
The important note being, I'm Brad Pitt in that scene, and you're Jonah Hill. Keep going.
Yeah.
Okay, you're good. I'm just saying.
Yes, true. It's true.
You had your shot.
I usually do play Jonah Hill in the little. When we remake that scene, I'm always Jonah Hill.
What are we all after, everybody?
Getting on base.
There we go.
Okay. All right. Okay. All right. Jonah Hill's lost some weight, though.
He does.
He's lost some weight. Okay, he's looking better. All right. But here was the other takeaway I had that I don't know why it's just been in my brain the whole time. Was Jameson on the panel yesterday said his former employer, Goldman Sachs, just came out and it freaking popped up on my news feed in my phone this morning. I swear it's like listening to all these conversations, that they have said the S&P 500 from here on out is going to grow at 3%.
Wow,
Goldman Sachs, that's what they said.
Wow.
And I was like, holy shit. I got some money in the S&P 500. I think that's the safest place a lot of people have gone. Tony Robbins' book and Peter Mallouk, some of the smartest people out there. Peter Mallouk's the #1 financial advisor. They're like, buy the S&P 500 if you don't know what to do. And now they're like, 3%? You're not even beating inflation at that. And so to me, that's made this conference that much more important. The Alternative Asset Summit and finding other investments and finding value. So that was my #1 takeaway.
Well, great takeaway. Mine was I had the opportunity to speak yesterday, and for those that are listening to the podcast, you may get the recording at altassetsummit.com.
Oh, nice.
Yeah, appreciate that. That's for you. You can pay me later. And anyway, the topic I covered, and a lot of people came up to me after at the reception and said, "Oh my gosh, the family office concept." I kind of threw it off the cuff. I was riding over here in the back of my Uber, and I was writing down, I'm going to finish with family office. That's a great idea. And so that is how it was kind of born, and I need to talk more about that. But so the concept was all of us can have our own family office. It's not just for billionaires. We need to manage our affairs, our finances, our balance sheet, as if it was a family office, as Wall Street or the big money people would refer to. We should have updated financials and our entities in good order, and we should have a meeting with our loved ones and talk about our dreams and passions and take tax deductions as a family when we travel and be building wealth as a family. I have 2 LLCs where all of my kids are partners in that LLC. And it's been a great opportunity to teach our kids. This last year, Patty and I invested in 2 Airbnbs, and the biggest takeaway we had from our Airbnbs, or the biggest benefit, was that our kids showed up and worked with us in the Airbnbs. And it was such a neat experience. And we can invest together as a family, we can build together, and doing that whole Airbnb thing was just life-changing. So the point being is, I think we're missing the boat. There's so much opportunity to plan as a family, have a family office, and build wealth together, and take great tax write-offs in the process. So
Yeah, I freaking love that. And I came in and watched your stuff. I've seen Mark speak 200 times, I think. I don't even know.
I know, it's old.
And I still have to come in here and see him speak. I freaking love it. And I love that takeaway because I think, money and finance and investing a lot of times is so like dollars and cents, and we're not talking about it to the person we love the most and our kids that need to learn this. And wouldn't it have been awesome if your parents did this for you and brought you along in that and helped you understand it? How much further ahead would you be if you just had that experience with your own parents? Even if that balance sheet and financial statement you talked about doing, which I thought was cool too, and you pulled the audience, and a lot more of them did it than I thought.
Yeah.
And but even just doing that, and I don't care how many zeros are at the end of it, but the exercise of it is what is really important. And I thought that's a great takeaway, and I love that part.
Well,
Okay, well, let's get some of the people that were here at the conference. We have Kate over here. And I ask these people, and I feel like I'm always strong-arming them and putting them in the spotlight because so many of us don't want to talk about money and some of the things we're doing. And when you have success, even you guys saw, John Shikarch up here, I feel like twisted out of him. It's like he's done really well, tell him that. People want to hear that. And so Kate, I had a great conversation with her, and she came to one of our events 2 years ago. And so I just wanted you to share that with everyone else. Just what you told me, if you don't mind.
Okay, and if I forget anything, I guess just ask some curious questions. Hi, everybody. My name's Kate. I live in Milwaukee, Wisconsin. About 6 years ago, I guess a little more story. I was in retail for about 13 years, moved 7 times. I was promoted a lot, so I got very used to moving, starting over, a little addicted to renovating. And 6 years ago, I ended up buying a historic church that's 150 years old, and I turned it into a wedding venue. I bought it for $425, which was like $17 a square foot, and it ended up being $8 million, so it kind of felt fake. I learned a lot. I think it's good that I didn't know what I didn't know. But I opened in 2020. So April of 2020, my project was ready to go. And
A lot of wedding venues right then.
yeah.
That's a great timing.
Yeah, it was 10 people per event, no dancing, and boxed meals were the restrictions in downtown Milwaukee. So no one would touch me with a 10-foot pole. And people book weddings a year out. So I have never felt more broke in my life, thinking I made the worst decision of my life, and had a lot of people I really cared about that invested in me too. So there was a lot of anxiety that kind of went with that too. It was one of the hardest and most difficult times, but it is crazy. I came to this conference 2 years ago, and I remember thinking, I can't afford the hotel or the flight. Like, I used my points and figured it out. And now, 2 years later, if anyone had told me I'd be in the position I am now in just 2 years, I would have said it'd take a decade. So very proud of myself for the position I'm in now, but I've done over 51 deals between my HSA and my Roth IRA. I learned about this a significant amount here and a little bit more in my RIA. And I did all my backdoor conversion. My dad thought I was doing illegal activities. And I said, Dad, I figured it out. So about a year after he was seeing me just do this, he said, will you teach me? And he's done over 30 now. And he told me I changed his life with retirement because I did not come from wealth. So this was a significant difference in our family's life.
So what position are you in now, are you saying?
Position.
You share some numbers?
Okay.
You're like a billionaire now, or?
I'm sitting on $1 million cash in my checking account, so that's one reason I'm here to figure that out. I've never had that much cash.
So how much is the church worth now?
The church, I don't know exactly. I've already paid off 7 of my 12 investors because I had to raise $2 million in 6 weeks. So I hadn't raised $5. I was pretty shocked, that happened. A lot of them knew me, or it was through my RIA. Half of my investors they use their Roth IRAs. I'll have everyone paid off by 2026.
And then on your own deals in the last couple years, you've done 50,
I've
right?
done
I remember
52.
you said you...
I had like, I think I've done 20 more since in the last 2 years. I've done 20 more. I had 30 under my belt before that.
And let's just say she's got 7 figures plus going for it
Yes.
right now. Okay.
Okay,
All right.
good job.
All right.
That's
okay.
what I want.
Well, it's
Just a general number.
People are a little shy about that.
Yes.
All
I hear you.
okay,
I hear
all
you.
right. Mark's a bulldozer sometimes.
Okay,
So,
yes.
you know.
Wondered what was going on.
Yeah.
That's all.
Okay. So...
Congratulations, too.
Thank you.
Everybody, come on.
Thank you.
Woo, woo. Yeah. Look at that. Just the...
And the reason I asked Kate to say that is because I think a lot of people feel stuck, and a lot of people talk about problems, and sometimes you have success and we're just not talking about it. But it can help other people. And I think Kate's just a great example of that. You had a lot of challenges and continue to push forward and broke through. And so I'm just grateful we played any part of that. And
Thanks for sharing that,
Yeah,
too.
and for
Good luck.
anybody here that hasn't done an investment, like meet people here. That's how I've done most of my investments, are through just networking, and then obviously do your background checks on the people you meet with. But it's really scary, that first one, and then you get hooked.
Yeah,
Okay,
awesome.
all right.
Okay.
Okay, now
Thank you.
I want to call an audible, too, but let's do
Okay.
our second one, too.
Okay, all right. Okay, we got
Kate,
Scott.
Thank you.
Scott is right behind
Okay.
Kate, and I got to talk to Scott last night. I don't know, I maybe talked to you 10 years ago, how long ago, or so, but just tell your story too, because I was like, I left talking to you, just so you know, and I was like, that was awesome. I just was like, it was an awesome conversation.
So 17 years, so Scott, I'm from Phoenix, originally from Chicago, but 17 years ago, my friend invited me to a weekend conference that Mark was presenting at. So I learned about self-directed art, self-directed.
So it wasn't Matt. Okay, keep going.
It was definitely Mark.
Just wanna make
So
sure.
self-directed retirement plans and how to learn, and I thought that was like the best pearl of knowledge I've learned in a decade, and it really changed my life. And I started in 2010. They had the IRA conversion rule, so I converted my old 401k to a Roth.
Yeah.
29,000 I started with, and I built that to 20 single-family rentals in that portfolio, and I added another traditional IRA self-directed with another 20 properties. That I did another 65 properties, single families, that are rentals, that are in multiple LLCs outside of my IRA. And then I've done about 40 flips. And then last year I started my first multifamily. Wow. So I've been following these guys for 17 years and educating myself along the way. And every time I have an opportunity to come to these events, I always walk away with a new idea and recharged and wanting to further my legacy.
Wow. Thank you so much. And probably multiple figure, again, result after $29,000 in a Roth.
Yeah, I've almost $5 million in my IRA.
Wow.
Yeah, right?
Thank you.
Wow. Okay, cool.
Okay.
All right, Scott, that was you got on base a lot.
grab his
That was a lot of base hits, right? Those
Started
single-family
early.
rentals aren't home runs.
Yeah, slow and steady.
Exactly.
Okay.
Okay.
Scott, okay. I wanted to throw this out too, because I think this story is so fun. And I'm going to put her on the spot. And I think a lot of you, if I don't get emotional, think, well, I might be too old to do this. Or I'm, not smart enough to do this. Or I'm like all of these little things. Well, 3 years ago, we were sitting right here doing the same class. And we were talking about all this, and crypto was a bigger topic.
Yeah.
And do you remember Crypto Grandma?
Yes.
Do you remember Crypto
How
Grandma?
could I? She was in the front, like on this side, maybe?
Yeah,
I
she
can't
was
even
sitting
remember.
right
Yeah.
over here, and she's like 80-something years old, and she's like, I'm trading crypto in my Roth IRA, and I'm doing this deal and this deal, and everybody's like, what the hell? She is here today, 3 years later, and she's right in front of Jared, and I don't know if she'd say what she's doing. You got to tell your story. Come on, just a little bit. Come on. There's our crypto grant, 87 years old. Woo!
No more dinners.
Okay, so you started with crypto in your IRA, right? No?
Yeah.
Okay.
Yeah.
Just kind of what you've been doing, just a little story.
There isn't much to tell, okay? I did not expect this. Thanks a lot. I just started trading crypto because I knew about Bitcoin a long time ago and thought, oh, that's for crooks or whatever. And, and then I found out that I really, I've always liked the stock market. I know you don't always agree with me, but I fancied myself a day trader years ago. That didn't work out very well. I'm hoping the crypto works better. Anyway, yeah, so I've got the directed IRA with
Good choice.
14 beneficiaries. My
Oh, I
grandchildren.
love that. We should explain
yeah, you
that too.
remember that?
Yeah.
Anyway, yeah. And with any luck, maybe there'll be something left by the time I go. Anyway, that's it. It's fun. And I think it keeps my brain a little bit active.
Okay. Well, she's modest too about her success, but she's making big money with crypto and her IRA and her
Roth.
and her Roth because she
Love
was
it.
like, I'm going to build this Roth for my grandkids. And so she has all these beneficiaries of her Roth IRA, and she's trading away, and all the grandkids are like, "Go, Grandma, you can do it. Keep going."
Yeah.
They're her biggest fan. So
Yeah. I got 1/14 of this, right?
yeah. So thanks anyway, Sherry,
Okay.
for sharing.
Yeah,
Put her on the spot.
thanks.
All right.
All right.
Thank you. A little audible.
All right. Okay, we got the question here, and then Marlo, you can step out. So we got them in the shot. Thank you very much. And tell us your name, maybe where you're from, and then your question.
My name is Hendrik. I'm here from California. Don't hold it against me. First of all, I just want to say thank you for everything that you guys have, shared with us over the past few days. I started coming last year, and I just found out that you guys have been doing this for several years. So I hope you keep doing it for several more years.
Oh, thanks.
Awesome.
So thanks, guys.
Thank you.
I'm an engineer, so sorry for getting really nerdy about this question.
This is going to be
Buckle
Mark's
up.
question to
But,
Phil.
yeah, no spreadsheets, no spreadsheets. So I put together a few of my retirement accounts into a partnership LLC, and then I went ahead and participated in a syndication. And I had a question about how non-recourse debt works in that. So I got the K1, and it looks like some of the syndication non-recourse debt was attributed to my ownership percentage on the K1. Do I owe UDFI tax on that?
A couple more facts and then a question. Is it you have income or loss on the K1?
That was my
Loss.
question.
Okay, so you have a loss on the K1, but you know there's debt involved on the asset in the syndication. All right, go ahead.
Don't worry about it. But that loss will carry forward.
Track that loss, baby.
Yes. Okay, that loss carries forward. You'll use it in future years when that syndication sells the property and you'll see a gain come through that will be taxable. We'll pick that loss back up in any other years and net it against that.
And a little further, so let's say it's a $10 million commercial building, or $100 million, whatever, $10 million, and the debt is $6 million. So his debt to equity ratio is 60% debt to 40% equity. That's right now. That's okay. We know that there's debt. It's non-recourse, recourse. We don't care. You're just a minority owner in this big syndication. So you're getting losses though. They're doing cost sags, depreciation. Who the hell cares? You're getting a K1 with a loss. So you're going to keep a journal or a work paper, your accountant will, of all those losses that are just adding up, a little into a bucket. And then when the syndication finally exits and they sell their $10 million building for $20 million, then he's going to get a K1 with a big fat capital gain. And then we're going to relook at how much debt was there on the date they sold, not right now. So if they sell for $20 million and they pay down the debt $2 million, so now we're $1 million, and we're down to a $5 million debt on a $20 million sale, now you're only a 25% debt to equity ratio. So on the day they sell, we would do that math on the 990 or the 990T generally. Am I fair? Okay. Close. And then you're going to do that ratio, and then that would be your debt financed income, and we would take that loss, bring it forward. I'm oversimplifying, but that's when the day of reckoning is. You want to add a little bit to that?
I don't know if anybody's still listening on the podcast.
Come on,
but
that was good.
Mark uses that one on me all the time, so I want to use it
Yeah, fair
against him.
enough.
But yeah, keep in mind, this is only because of it's an IRA type thing that you talked about. You put in forward at the beginning of the question. And you take the average of 12 months of debt when the property sells, and it's technically not a debt to equity ratio. It's the adjusted basis versus the debt. Okay, there's a whole chapter in my book on it, but and that matters because it's your purchase adjusted basis is purchase price plus improvements minus depreciation. So it actually starts that number technically goes down over time unless they're throwing more money in improvements, but it's typically going down as is your loan balance. So, but that's the ratio you use. I hope that helps, but don't worry about it year to year, but those losses carry forward. The other nice thing is you don't need to file the 990T to claim that loss to carry it forward. The IRS lets you just pick it up at the time you want to use it in the IRA 990T
And did you say
context.
it's an IRA or a Roth?
Roth.
Okay.
Roth IRA, but I just saying it's not a
Roth
401k or a solo K that could be exempt from
Oh,
it.
bummer.
Okay, all right.
All right.
Great
Thanks, guys.
question.
Great
Thank you.
question.
All right, we got our next question. Let us know your name and where you're from.
Hi, I'm Joseph. I'm here with an operator at the Streamline Companies, and we're in Mesa.
Awesome.
Cool.
I really enjoyed the conversation and the training on the trifecta, the family office. Really appreciated that.
Oh, cool. Thanks.
We hear a lot about asset allocation, but not enough about asset location, which is what you brought up.
That was good. Asset location.
And the question there is around,
Mark's going to steal that.
I'm going to steal that.
it's
Keep going.
I don't TM it or anything.
Good.
But the question is, when it comes to philanthropic endeavors, is there a location in the trifecta that makes the most sense for those types of donations? Are we needing to set up a family office or a family foundation, or is there a side of the trifecta that makes the most sense?
Great question.
Yes, but follow-up question. Are you talking about donating to other nonprofits or building your own nonprofit?
In this case, donating to others, but it could be, if it makes sense, doing it from your own foundation, but maybe not everybody has that.
Okay. So stage one, you just want to be more philanthropic. You want to donate, you want to give your 10%, church, school, wherever, nonprofit. It's going to be at the very bottom of the trifecta, right out of your 1040. You're just going to do your donations out of your 1040. If you do it out of one of your pass-through entities, it's going to end up on your 1040 anyway. So you would just, so it wouldn't really, it would be on the trifecta, but down at the 1040 level when you're making the smoothie. So you're going to do your donations there, and if you are itemizing, that's where you would pick up that deduction. Stage two, you're like, oh, I want to do my own family foundation or my own nonprofit. We usually put that outside the box kind of on the left because it's not really an asset. A nonprofit's never an asset of yours. So I don't like to blend it on the right-hand side. I like to keep it over on the left. And it's going to stand alone because you don't own a nonprofit. It's just going to kind of be over there. You're not going to take a salary from it. And a lot of times it has kind of a sister company role with your operational entities. You're trying to fund it from your operations and make sure you don't hit private foundation status, keep it as a public charity status. But anyway, it would be off to the left on the operations side as a standalone bubble. So we kind of put it as its own little bubble over there. Matt's now choosing the colors of our bubbles on the trifecta. He saw that trifecta and just cringed. He doesn't like all the colors.
It's like primary colors. It's like, I just couldn't handle all the colors.
He couldn't handle it. But
Anyway.
anyway, so that's where it would go. Does that help?
Yeah, and I'll just say a couple other things on that. That's a great question, by the way. Is like your IRA, right? When you have a big IRA, your traditional IRAs in particular, you can take if you're in RMD age, which is 73, you can take a distribution from your
QCD.
IRA, not pick it up as earned income, and it can go right to a charity. And that's another great strategy a lot of people do that want to give more to charity. Eat up the RMD in their IRA, not pay income tax on it, get the charitable deduction. It's a little double play type thing. That's not just a base, that's a double play.
And that could be cool if you talk to your grandma or grandpa and go, hey, I'm starting a nonprofit. Are you doing RMDs?
Yeah.
Say, I've got this great idea.
Yeah.
Anyway.
Great. The other thing I'll see is the donor advised funds are super popular. Those are becoming more and more popular. I'm seeing clients use those where you can make a charitable contribution to a donor advised fund, and then you can have control of where that fund money is then donated to nonprofits during your lifetime or later on. And it's kind of an in-between of doing a whole family foundation or a nonprofit for yourself. You could do those donor advised funds. The last thing I'll say is Devin Muntins is the lawyer in our law firm that is the nonprofit guy, and he freaking wrote a book on it that's going to be published soon. So if anyone here's like wanting to do a nonprofit, you have a really cool charitable idea, and this really needs to be really charitable, okay? Don't try to make money on a nonprofit. That's not the purpose of it. Really charitable stuff. Devin can help you in our law firm.
That's great. And then is there any issues, since we're at an alternative assets summit, with donating maybe an LP interest? Does that get dicey, or
Donating
you're
to
taking the
healthy-
deductions and
A
everything
limited partnership
during
interest,
the year?
donating a limited partnership interest to a nonprofit.
Right, and you've been using the deductions, the losses, and then maybe like those last couple of years you don't have anything to offset those gains, and so you end up donating that, and then the charity doesn't have those same taxes.
What was your name again?
Joseph.
That was a tricky question, Joseph.
I'm sorry.
So, okay, can any of you donate a house, a car, a partnership interest? Does you have a X percent in syndication? Can you donate that to a charity? Sure.
Do they want it?
And yeah, so that's another. But
So the
can
first
you
thing they would
anytime-
do is sell it when you donate it after.
Yeah, and you get the fair market value analysis, so you can figure out what your deduction would be. But I would ask, what's the motivation behind that?
Maybe you like, just like you could donate a piece of real estate, right, that has gain in it, and so you don't want to sell it and get the cash and donate the cash. You want to donate the real estate or the limited partnership interest that could have a gain in it, and then they can sell it, the nonprofit, and not pay tax and take the whole money.
Is that
right?
what you're saying?
That's possible.
great. Yep.
Your challenge will typically be as the nonprofit on the other end of it that's like, what do we got to do?
And can they liquidate it? Because
And
if
then
they
you got to
can't
get a
liquidate it, they may
valuation
not
on it
want
too. Otherwise possible, though.
Yep.
Gotcha. Thank you for that.
Great. Thanks.
Okay, we got our last question right here.
Hi, everybody. Thank you, Matt. Thank you, Mark.
Oh,
Our
thank
pleasure.
Putting on the event. It took a lot of nerves coming up here because going behind these first two people, they got a lot of bass, got on bass a lot. But I have a simple question. So I just retired.
That was a good one.
See that?
I just retired, and I have a Roth IRA and a conventional IRA.
Traditional.
Traditional, both
Yeah.
with directed.
Smart. You're already off, dude. You're on second base already.
That's good to know.
Normally, this is talking about Matt's high school years, but keep going.
I knew that's what he was laughing about. I was like, what is he laughing
Yeah,
about?
Matt got on base once in a while in high school, but anyway, keep going. All right.
So my question is, when is the right time? I want to
Okay,
convert.
can I take a pause for a second? Okay, I'm sorry. What was your name again?
Courtney.
Okay, I want to be real with you guys for a second.
What-
Okay.
what?
I got my girlfriend pregnant in high school. Let's not forget that, okay?
I wasn't going to say it. You said it.
You guys saw my daughter back there? I'm 44. She's 26. Selling my books, okay? All right. Okay,
Wow.
I'm sorry.
Okay, I struck a chord. Sorry about that.
I mean, it was like, I wasn't trying to, but that's my story. That's my story, you know, guys? Okay,
Yeah.
that's my story. All
We'll
right.
just quit talking about getting on base. Okay,
Yeah.
keep going.
All right. Mark will get distracted, okay? Sorry.
No, it's all
You got a traditional IRA and a Roth IRA.
So I want to convert the traditional to Roth.
Got
but
it.
my question is, what are the considerations? Like, should I do it? Like, what are considerations for converting? You know.
Oh,
Okay.
I love this topic. Chunking. We're talking
Take it
chunking.
away. Take
Man.
it away.
Now, we take this from the movie Goonies with Steven Spielberg and Chunk, because we're a big fan of Chunk. That's where this all originated. Okay, chunking. So, what we would want to do is this time of year is perfect for this, all of you. Because where we want to be is at a Roth IRA. We want to be in the Roth IRA party. What's it, Gamma Sigma?
Kappa, Gamma, Roth? I don't know. Alpha, I
Kappa
don't
Gamma
know.
Roth. We want to be
Whatever.
all in the Roth party. Like Jim Belushi and Animal House, we want to be in the Roth party. Everybody's wearing toga. Well, that's where we want to be. Roth party is where we want to be. So I totally commend you for this. So between now and December 31st, if you want to get in the Roth party, you got to decide how much you want to convert from your traditional to your Roth, right?
Okay.
And what considerations should you have? Great question. Because it's going to be a taxable conversion, you want to say, all right, if I do X dollars, is it going to put me in a higher bracket?
Can we ask the amount of traditional? Do you want to convert?
It's about 80K.
Okay,
great.
That's a good number. Because see, what we'd want to do is in the next 2.5 months, you'd sit down with your tax advisor and go, here's where I think I'm going to be this year. They'd look at your 2023 return and say, What's changed? Are you going to make about the same, make more? That's a great starting point. And you go, I'm going to make about the same. Okay, then we can say, okay, here's where your tax bracket was in 2023. This will be where we think your tax bracket will be in 2024. So we'd want to know, if you convert that 80, where do you end up? What's that next bracket?
Right.
Because there's two, in the 7 brackets, there's 2 that suck. They jump up about 8 to 9%, 8 to 10, right?
Yeah.
Bill, is about, there's an 8% 2 times. Well, you don't want to be in the one that bounces you into the 8% increase. So you kind of want to like find the sweet spot. And you may go, oh, this is cool. You'll go into 2 brackets, but you won't jump more than 4%. So let's make that conversion. And then the next question is, if we do, can you pay the tax? Like, where's it going to come from? You have till April 15th. So could we drum that up between now and April 15th? So what you want to do is like find that perfect amount to convert. And maybe it takes a couple years. Maybe it takes 3 years. You chunk 20 grand here, 50 grand there, 40 grand there. But you want to get it converted as soon as possible at the right. But there's so many considerations too. Valuations. What are you investing in?
Yeah.
I mean, there's so much.
What was your name again?
Courtney.
Courtney. Okay. Here's what I'd do. Okay, we're in October here, the end of October in 2024. I would do 40K now, and I do 40K on January 1st. Break it up over 2 years and just get it freaking done. Okay, I converted my last dollars of traditional, maybe 180 or something or whatever, this year. And I was like, damn it, I got to do this myself. I've been like, I stopped contributing to traditional and going all Roth, but I had some 401k money, some match stuff, and I'd never converted. And I'm like, screw it, I'm just pulling the Band-Aid off. I'm not even chunking. Now, you might be like, well, Matt, I'm already in the 37% tax bracket either year. It doesn't matter. Doesn't matter. Then just rip the Band-Aid off. That's what I just decided to do. Or look at the bracket analysis like Mark talked about. But I think if it's 80, even if you're going to jump in the next one, I'm just like, just break it up in 2 years, get it done in the next 60 days. Now you're all Roth starting 2025 moving forward, but I at least broke it up between 2 tax returns.
And it's short-term gain for
short-term pain.
For short-term pain?
Short-term, okay, so let's start that over.
I always screw this up. Short-term pain for long-term
gain. All right? Okay, all right. Okay. I was like,
nothing to work.
Yeah, that didn't work. Okay,
Courtney,
all right.
That's good. Is that kind of the...
Did that help?
Yes, that helps. Thank you so much.
Okay, thank you, Courtney. Okay, we got one more question here.
I want to say one more thing, Courtney. You can hand off the mic. You're good. But I'll say this about Courtney's case, too.
And then we're going to wrap it up.
Yeah.
Because thank you for hanging in there,
Is
guys.
that you kind of want to think of like, there's 2 issues. If you're going to do a conversion, what is that asset? Is it cash? Because it could be in real estate. Maybe Courtney's 80 grand is in real estate. Oh, I could get a low appraisal right now. And then I can convert it before it goes up even more. Also, you may say, he's sitting on an investment that could really be a big deal. So now you're like, holy crap, I better convert it now before I do that deal. Yeah, so there could be what is the money in? What's the 80 grand in? And where am I going to put the 80 grand? Because he may say, well, I'm going to do an investment in November. Well, holy crap, do the conversion now and get it converted before that investment. Because what you're doing is it's kind of a Roth freeze, like a Dairy Queen thing. You're going to freeze that Roth. It's done. You're never going to pay tax again. So I want to freeze that value and get that conversion done too. So a couple other factors to think about.
So
Sorry, go ahead.
Yeah, my name is
Dairy
Eric.
Queen?
I'm trying to relate to the people, Matt.
I like Dairy Queen. My name is Eric. I'm from Albuquerque, New Mexico. So I wanted to ask a follow-up, kind of piggybacking off of Courtney's question, because I'm in the same boat. Okay. I'm sitting on an old IRA that was sidelined from a previous company match plan, and it's kind of sitting there. Haven't been doing much with it. I was considering doing Backdoor Roth, and there's some pro rata rules that I'm not real clear on. But if I did, so let's consider I do chunking. I'm at about 170,000 in that account. So if I wanted to chunk it, would the pro rata stop me from doing Backdoor 7,000 Roth contributions, or am I better to just bite the bullet, move the whole thing, and start doing the
Great
Roth?
question.
This is up your alley. This is
Great
good.
question. See, this is a dilemma. You've got a common dilemma of a lot of our clients, which is you have traditional IRA dollars. And traditional IRA dollars will stop you from being able to do a backdoor Roth IRA, because what they say when you do a backdoor Roth IRA, you have to do a Roth conversion. Well, when you do a Roth conversion to do a backdoor Roth IRA, they say, wait, you have a traditional IRA over here too? You need to convert some of that too. And you have to do it pro rata. And they actually say the deductible dollars need to go first. So basically, it's hard to do a backdoor Roth IRA if you have traditional IRA dollars. Now, you can have traditional 401k dollars. Let's ask a couple questions. You got a side hustle or a business on the side? Okay, thumbs up or thumbs down? Thumbs up, you got a business on the side?
He's got a full-time hustle with full-time employees with a safe harbor 401k. All right.
Here's what I was...
Married or single?
Married.
Okay.
Married. My wife's already doing the backdoor Roth max contributions on hers.
Smart. Okay, love that, because she doesn't have a traditional IRA.
Correct. She works for the state, so she has a state employment plan and pension.
Okay. All right, here's why we're asking these questions. If the traditional IRA dollars are in a traditional 401k, then you can do the backdoor Roth IRA. No one cares about what's in a 401k when you're doing a backdoor Roth IRA. So you have a couple options. One is you could roll it into the 401k with your safe harbor, but now you can't self-direct it because you're over here doing Wall Street stuff and mutual funds. Blech. So you could do a solo K if you have some other side business, but you got employees in this, so you're going to be tough. So we're back to chunking.
That's what I figured. Yeah.
I was trying.
Yeah.
Hold on. Couldn't his wife open up a solo under a side hustle?
No,
and
because...
he could roll his old into that, couldn't he?
No, when you do the spouse one, it's only the spouse that can participate separate because he has employees.
But that's with new contributions, but it'd be a rollover.
Yeah, but you have to be an employee. I don't think it would work. Maybe, but probably not.
Well, thank you. That's what I was
Do the
figuring was the
chunking.
chunking. That's what I figured.
Bite the bullet.
Yeah.
Because let those Roth dollars start working now. Remember.
Short-term pain for long-term
Gain.
There we go. Boom. Boom. There we go.
Okay, let's end with that.
All right. That's a great question.
Okay, all right. Well, thanks for everybody for being here live, for all of you listening on the podcast. Why weren't you at the Alt Asset Summit? And don't miss the next one.
Yep.
AltAssetSummit.com. You can catch the recording, as we said. And any other parting words?
Yeah, you brought us in, so I'm going to take us out. That's one of the rules on our podcast. You almost violated the rule.
I forgot.
All right. We will be here next week for another episode of the Main Street Business Podcast. Please give us a 5-star review, share it with your friends or family, and continue to live that American dream. It's real, and self-direct on.
Thank you, everyone.
Woo!